Nilesh Shah, Managing Director of Kotak AMC. And today we'll not talk about India, we'll talk about his understanding of what is happening in the US market. First, the fall of SVB and now this rescue. Nilesh bhai, good morning. I know it was a late minute request, yet you managed to accommodate it. So really thank you for that. Just break it for our viewers that why this bank has failed. And after the rescue by the Fed for depositors and for existing borrowers, has the storm come and gone?
So Nikunj bhai, SVB was geographically concentrated bank in Silicon Valley, having very high concentration of bulk deposits. About 97.3% of their deposits were above 250,000, which is FDIC insurance limit. So it's geographically concentrated and sector concentrated bank. Their clients were mainly startups. They all got a lot of money when interest rates were low a couple of years back. SVB took deposits at attractive rates, and in order to earn carry of 40 basis points, they went and invested into mortgage-backed securities. This mortgage-backed securities were giving carry in the initial days, but as US interest rates moved up by almost 5%, there was a huge mark-to-market loss. Depositors who were smart recognized that SVB could be in trouble and started withdrawing the money. In order to fund those deposit outflows, SVB had to sell their portfolio and book losses. In order to recapitalize the bank, they announced a large equity offering of $2 billion plus, and that opened the floodgate. Everyone wanted to get out of the room because bulk of the deposits were uninsured. Finally, FDIC, which is equivalent of RDIC-GC, intervened and took the control of the bank. Over the weekend, Fed has come out with a Fed, the US Treasury and FDIC has come out with a relief package. They've ensured that all deposit holders will be protected irrespective of whether they have insurance or not. The equity holders and bond holders of SVB will have to take losses. Another bank, Signature, which was also facing similar trouble like SVB, also has been taken care of. Essentially, Fed has ensured that this contagion doesn't spread. There's no flight to safety from lower rated banks, regional banks, to higher capitalized banks. Depositors' interests have been protected, panic has been prevented, and hopefully they'll now learn from SVB crisis and tighten the regulations. For example, stress testing for SVB was fairly low. There was no restriction on how much they could put into HTM like Reserve Bank of India has prescribed for Indian banks. So I'm sure Fed will take corrective action like they did in 2008 and ensure that SVB is not repeated again.
Nilesh, I also want you to use this platform to try and ease all the Indian investors, because over the weekend or on Friday night, when you had other banking names as well in the US fall, I mean, everything from a JP Morgan to a Wells Fargo to PacWest to First Republic, Citigroup, there was so much panic out there as to the contagion impact that SVB could have on even Indian banks, for instance. So just want you to address to the viewers right now as to how that has no correlation at all, and especially, the retail janta out there.
So essentially, our banking system is in a far better position. For example, SVB, out of their $200 billion balance sheet, could put $100 billion into HTM category. That's not permissible in India. Reserve Bank of India caps how much you can put into HTM category. Second thing, in SVB, deposit outflows moved very, very quickly. In India's case, our deposit base is widely distributed geographically as well as across various industries. And hence, this kind of deposit outflow is unlikely to occur. Third, in SVB's case, they were focused on bulk deposits. In our case, it is retail deposits. And more importantly, our regulators are far more proactive compared to SVB. If you remember, way back in 2008, there was a run on one private sector bank because one of the ATM went dry. It was a local event, not even a regional event, but yet RBI intervened to ensure that that bank remained open and kept on sending cash to repay all panicky depositors. People who were driven by panic and rumor mongering withdrew money, and then next day they all came back to deposit thanks to the immediate intervention at the local level. In SVB's case, we saw Fed had to take few days to intervene. So put all these things together, better regulation, quicker responses, much diversified this deposit base. I don't think so. SVB kind of things will happen in quote unquote regulated and supervised sector of finance in India. We do have our SVB equivalents in chit funds and nidhis and collective investment schemes. More than 1.8 crore Indians have lost close to 2 lakh crores over last 20 years in variety of Ponzi schemes, whether it's EMU scheme, Tickwood scheme, plantation scheme. That segment, the unregulated, unsupervised segment of collective investment scheme is SVB of India.
The comparisons which everybody has again been talking about on social media, now social media is social media, but these comparisons have been drawn that this is a 2008 kind of a Lehman moment. Is that all hogwash? Can we just dismiss it with a big no?
So undoubtedly, this is not Lehman Brothers movement because one, post Lehman Brothers movement, Fed came out, the US came out with Dodd-Frank Act, and it took away some of the luxuries which financial sector in US had earlier in terms of leverage. Second, Fed supervision has increased substantially on what is quote unquote systematically important financial institutions. SVB was falling out of it. Lehman or Bear Stearns would have been inside systematically important financial institution. Social media obviously is in overdrive. They will keep on spreading rumors. Like today, I am part of a WhatsApp group where someone mentioned that in India, bank run is not possible because, when you want to close your bank account, they'll ask you for KYC, they'll ask you so many questions that you will decide not to close the bank account. Now, this kind of comments are completely uncalled for. They are in lighter vein and people should not take it seriously.
Nilesh, you've always mentioned that it's not really any other binary event, nor even SVB. It's the Fed's interest rate trajectory, which is the real big worry and concern and trigger for the market. Going by Jerome Powell's latest commentary, it doesn't seem like the Fed is quite done yet. What happens then in that case if the Fed were to get even more aggressive from here?
So it's $1 million question. If you want living example of between devil and deep sea, there's no better person than Jeremy Powell. He's doing tremendous balancing. If he raises interest rates, over leverage US government, households will have to carry the burden. If he doesn't raise interest rates, inflation does not come under control. Unlike Mr. Paul Walker in the 80s, who had the luxury of raising real interest rates to 10% and nominal US interest rates to double digit, because debt to GDP ratio of US was far lower. Mr. Powell does not have that luxury. And he's kind of playing a game which is, very, very delicate balancing. On one side, he has raised interest rates at the fastest pace in the US history. On the other hand, he has been relatively slow in taking away excess liquidity from the banking system. Fed expanded balance sheet by $4.8 trillion rounded off between 2008 and 22. And now they have taken out about $600 billion. So over 2008, there is still $4 trillion plus liquidity in banking system. So Fed was hoping that by raising interest rates, inflation will come under control. But by not taking away liquidity as quickly as possible, hopefully growth will not go into severe recession or depression, and it might just be a mild recession. For this strategy to succeed, Fed had to ensure that there was no accident. Unfortunately, SVB created a jolt for Fed. Now with Fed, US Treasury and FDIC, they have tried to tackle SVB and signature crisis. Hopefully, Fed will be driven by data dependency. They will carefully evaluate all the incoming data to take a call whether they should keep rates higher and for longer.
The reverse side, that could Fed get more aggressive. But what are the chances that Fed could think that, okay, interest rate hike has started backfiring, whether it is the economy, whether it is the US tech sector or the financial sector per se. So don't increase interest rates. Let's hit a pause. So what happens then?
So Fed will have to be very, very careful because yes, there are segments like housing, technology, startups, where Fed's impact of raising interest rates is visible. But there are sectors like labor market where Fed's impact of raising interest rates is not visible. Inflation has not yet slowed down. US real interest rates are still negative. And hence Fed will take a very, very balanced, nuanced steps in this open minefield. My feeling is that Fed will be kind of, showing the stick of raising interest rates and tightening liquidity, hoping that this will curb the demand. But at the same time, they'll continue to provide liquidity, hoping that SVB kind of accidents don't occur. And we probably come out of this situation with inflation just little above Fed's target range of 2% and a recession which is very, very mild and probably for 1 or 2 quarters rather than which is very, very deep. But Fed will be taking steps based on the incoming data. They'll probably use forecasting models to figure out how their steps taken by them is impacting US economy. It's a very, very tough job. And all my sympathies are with Jeremy Powell. He's doing a fantastic balancing.
That's a good one. Nilesh, great to have you on the show as always, and thank you for, giving us your sound bit of advice and, really explaining what really is going on behind this entire SVB saga. No reason to panic.